The first 12 days of January have been absolutely gut-wrenching for global and local markets. To make sense of all of it and how it might still pan out for the year, my guest today on the show is H Nemkumar of IIFL. Naim, very good to see you after a long time. What a start to the year we've had. It's just panning across the board. All hell seems to have broken loose. How do you think this year will pan out? How big is this global problem that we are grappling with today?
Actually, Udayan, we should just take a step back and look at what happened in the past 6 months. There was a build-up to this, what is happening today. Slowly it was happening. But, for an equity market investor, there are three key drivers. One is cost of capital. The other is return on equity, the trends in return on equity. And the third one is, of course, the earnings growth. Now, look at this. Last 6 months, the earnings downgrades that we have seen have been one of the highest in recent times. So, if you look at FY17 EPS numbers for our index and what the estimates were in FY13 and the current EPS estimates today, they're almost 30% lower. So, that big tailwind that was needed is definitely not there. The second thing is cost of capital. Reserve Bank cut rates by 125 basis points last year. Long bond yields are almost there where even before the rate cut, the rates that were there, the rates are there today. So actually the yields have not come down, long bond yields, and that doesn't help the costs. And the risk premia in an environment where none of us are able to predict commodity prices, earnings of companies, currency trends, how credit spreads will behave, it's natural that risk premia widens. So it's been gradually widening and it had to give way at some point in time. I think looking back into the history, we've not seen the worst there because when there is a sell-off in credit markets, the equity risk premia widens very sharply. And the sensitivity of marginal changes in cost of capital and equity risk premia on the fair value of the market is very, very high. So cost of capital is widening. And the third one is capital efficiencies. Few of us look at long-term trends in terms of, where the ROEs of companies are there. And it is at our own peril that we don't see these numbers. Now, the return on equity in 2007 over the cost of capital was over 10 percentage points. Today, actually, the return on equity is below cost of capital, cost of equity. And therefore, if you actually look at all these three parameters, there is a justifiable reason for the derating of the market. Now, for the year, the outlook remains very challenging, notwithstanding the bumpy start that we have had this year. I don't see things bottoming out anytime soon, simply because of the fact that you could well see newer and newer geographies getting engulfed into this crisis. Last year was, the Russian economy shrank by 40% in dollar terms. The Brazilian economy shrunk by 25% in dollar terms. And now, there's a genuine worry as to what is going to happen in Middle East. And therefore, when you look at all these parameters, it looks like it's going to be a very challenging year for generating returns. And I'm not so sure whether risk will be adequately rewarded and the valuations are not attractive enough, for us to jump in.
Excellent points you make, Naim, and I'll pick on all of those. But let me start with the last point that you make, because that is really what people are grappling with. After a correction of about 15–17%, have valuations cooled off enough for people to start buying? Or would you say, looking at long-term history of difficult periods in the market, which you described, valuations can actually contract far more before they bottom out?
I think there is a risk that valuations will contract even more from here. See, Udayan, look at this. Every year we forecast earnings growth of 20%. And based on that earnings, we say, oh, the market is now trading at median multiples, and with this kind of growth, we should jump in and buy. End of the year, you downgrade numbers. And then what happens? Suddenly the market looks expensive. The call is more on growth. And today, despite the big downgrades that we have seen in earnings of companies, my worry is that we are not fully done. And in a phase where earnings growth is weak, or earnings downgrade momentum has not waned, I think just looking at valuations alone is not going to help. My read is that till such time one of these start to change, either risk premia starts to shrink, or earnings growth visibility starts to rise, there's no point in trying to bottom fish in this market. Now look at this. I mean, in the market itself, there's a dichotomous trend. Where there is earnings visibility, even if there is a 15% earnings growth, people want to jump in and buy those stocks at crazy multiples. And where there's no earnings visibility, people just don't want to touch. So if you look at the basket of stocks that you would like to own based on decent earnings visibility and decent ROEs and cash flow generation, those companies are so expensive that the investable universe itself has shrunk. So this is the other conundrum that we have in our market. So put together, it is not going to be an easy environment.
That's an excellent point. But could that also change, Neem? That's my next question to you, because a lot of people are waiting to buy those companies which are expensive but which might come down in an overall panic. Do you think the global environment is such right now that you can get a waterfall kind of decline in the market where this kind of discerning behavior might go out of the window? The one that you described, that people are not buying the ones which are open to risk but looking at the ones which have earnings growth. But going by the history of previous falls like 2008, nothing was spared. Everything fell. There were degrees of underperformance. Could we be looking at that kind of a scenario, or do you think quality will still hold out in 2016?
Well, then I think 2008 was slightly different. The crisis erupted suddenly because of Lehman going bust. And overnight, risk spreads widened so sharply that any asset that people owned, they wanted to sell. So I recall that, Tata Motors bonds trading at like 65%, 70% yield and all that kind of stuff. I am not so sure whether that kind of sell-off will happen this time around, unless there's a black swan event, and none of us can forecast that. And in the absence of that, I'm not so sure whether people will, there will be a sell-off in the names which are very expensive and which a long-term investor would be keen to buy. So we'll have to wait and see how this pans out, but my base case scenario is that this may not happen. This is like, death by 1,000 cuts. It's not like if you have one sharp cut and there's a big sell-off, then all the pain, all the poison can get drunk immediately. But that, I don't know, I'm not so sure whether that will happen. We'll have to wait and see if there's a major blow-up, or, if some countries start to take steps which results in a contagion. I mean, if you recall, 97 crisis started with, Malaysia imposing capital controls and that kind of stuff. If a few such things were to happen and there's a big sell-off in currency markets and consequently credit markets and risk spreads widen, who knows, it can happen. But I'm not so sure whether it's going to happen in the near term.
What about the time factor, Neem, out here? I take your point that this time we're going in it with eyes open. The problem is well known. China will not spring suddenly on us tomorrow morning. But is it a fear that this problem will take longer to resolve itself, and therefore we could be shaping up for maybe couple of years of subpar economic growth globally, which means equity markets go through a protracted period of pain, maybe not the same extent of absolute price damage, but the time to get returns might have to get postponed by a fairly significant number of months?
Well, then that's very possible, because if you actually look at last couple of years also, save, US markets having done well and Japan to a certain extent, all other markets have already seen that phase of pain. And I know there are managers who tell me that, Brazil has now become so cheap, and but what is cheap becomes cheaper by the day because the other things are not falling into place. So therefore, if this grind continues for some more time, it could well get extended by a year or two, and the timing of how things unravel is always very tough to say. It's actually what happened in 2008. If it were to happen, it will be, to my mind, a better thing, because everything will get priced overnight, and then you can take a fresh look. Today, it's very hard to say when and how and what will drive that, and therefore, we'll have to live through this phase of pain. And as you said, it could prolong for a couple of years. Who knows? It can just get over in 6 months. Very tough to say.
This point will slip into a break. Back with Nemkumar of IIFL on Crystal Ball in just a minute.